Another thing I wanted to ask about, so you got to be careful sometimes not to take little things and turn them into big things, and I get that. But it is interesting to me. There seems to have been a shift in correlation between bonds and stocks since our last show 2 weeks ago. First of all, do you think that means anything? Because sometimes we're just going to have those types of things happen for random reasons. It could be, you may have the answer to that. Or is there anything that's fundamentally changed to cause that correlation to shift? Or is that just blip on the radar, nothing to think about?
Well, I think we've talked about this before. Good girlfriend, bad girlfriend.
Awesome. I love it when we go back to the good girlfriend, bad girlfriend.
Yeah. Let's give her a name. Let's call her Debbie.
Tiffany.
Oh, Tiffany or Debbie. Tiffany.
Amber. Amber's always a dangerous one from my experiences.
How about Barbara? A good, handsome woman. a big, handsome woman named Barbara with curlers in her.
Boy, we digress.
She's a good girlfriend until she's not.
That's right.
Where were we at the beginning of the year on yields? 457. Where did we go through January 10th? We went to 480. Okay. So what happened to the market? It pulled back through that time. Okay. A little bit. Then we started to have some data come out subsequent to that was yield negative, bond positive, started bringing the yields back down. And the market liked that. So the market will accept higher yields to a certain point. We will accept a bad girlfriend to a certain point. If you come home at 3 a.m. smelling like cigars and you're walking funny, then no, you're a bad girlfriend. We're not going to accept that. So, if you're out with girlfriends a little bit longer, that's okay. That's where the market is at 460. That's about the number the market doesn't like. Okay, and there's no tried and true number for this. That number that threshold that the market likes moves around based on many things, based on forecast earnings growth, based on the current economics of what's taking the GDP and obviously Trump. Okay, so I don't know that the market would be okay with a 460 10-year if we had a different president in there right now, not a pro-business president in there. Okay, I don't know if the market would accept a 4.6 10-year and a 4.6 10-year with a 22 plus multiple if we had earnings growth coming in at 9% or 10%. Okay, I don't think that would be okay. It's a combination of all of it. Okay, but like any boyfriend or husband, okay, we all have our limits. That limit's around 460, 465. Okay, so
basically, you're saying 465 is the equivalent of about 2:30 in the morning. That there is a limit of how late you can come home, and there is a limit to how high you can go with yields, and that's around 2:30 in the morning or about 465.
5%, 3 in the morning with the hickey.
Okay.
You know what I mean? Like, that's it. You're out. I'm selling. So
things you will only hear on the Intelligent Investment presented by ARPG.
So I think it's important that we sort of delineate between, well, yields went up, but they were already right at that sweet spot when we started the year, and it went up from there, and then it came down from there. So the market is still pretty yield sensitive. It's just that threshold is moving around a little bit as far as where it starts to move back and forth. And, we're sitting at 460 today. The market's pulling back a little bit, not too much. I think what the market is doing right now, it's getting ahead of next week's big week. It's just one of those massive economic earnings week. A lot's going to happen. The market's going to move around a lot. Doesn't matter how good or bad the news is. There's just going to be some turbulence.
If the quality of my question can be graded by your answer, that is the best question I've ever asked, because that's probably the clip of all time right there. You mentioned Trump, and it was funny. Somebody told me the other day that they were expecting a bigger rally after inauguration than we got, and I kind of joked with them. I was like, no, the market priced in Trump being president in October. You missed that. But then you made a good point there a minute ago that there has been a little bit of a rally around that because you're getting more speeches. You're getting a little shot in the arm reminder of Trump being pro-business and also hearing him say some things maybe that were not – you knew he was going to be president. You didn't know what he was going to do once he got there. So there are opportunities for him to still move the needle, I suppose. But it definitely sounds like you think that the Trump effect is fully baked in at this point, finally? I mean, are there other things that Trump can say or other policies that he can come forward with that you think could move the market that maybe we haven't discussed or thought of?
Yeah, I mean, he could further lower corporate tax rates. I know there was discussion of that early on in the campaigns. It's at 22 or 20% now, 21% now. I know he was talking about dropping that to 15. I guess anything's possible. That he's obviously a smart person, and he wants to make sure that we have enough money coming into the Treasury, obviously to pay our debt, to pay the bills, and because he wants to lower deficits. Scott Bessent, the new Treasury Secretary, I think is going to do a phenomenal job. I think he's an absolute just whip smart guy. He's more concerned with collections than he is politics. And he said that in his confirmation hearings. So I think there's going to be, and he's going to issue longer date bonds, maybe 50-year bonds, to sort of kind of help soften the debt repayment schedule, if that makes sense. And I think that's what he wants to do. But I mean, we're looking at Q4 earnings estimates are for 62.18, right? For this quarter. The year end, December 31st, that estimate was 61.52. So we're seeing revisions up on quarterly earnings, which we don't get that very often. I mean, it's not that it never happens, but normally the revisions kind of come down. I would say it's only about 30% of the time that we see revisions up, especially, I would say this is up about 2% over the course of about 2 weeks. Typically, we see earnings outperform. My guess is we're going to have our general call for Q4 earnings is about $64 a share for Q4 and probably $65 for Q1. Okay. $270 a share for 2025. We'll see where these come in. And obviously we talked about this for 2026, about $310, $315 a share. So there's a lot of earnings growth that has to happen, obviously, to continue to justify this 22 plus multiple, okay, in the face of a 4.5+% interest rate regime. And how much of that multiple includes two cuts, right? If we don't get two cuts, if labor comes in tight, right? If we get, next month, the jobs number comes in at 250, 300, 350,000 jobs, or we get 8.5+ million job openings, right? Next month, you could see that yield go above 5. That yield goes above 5. Okay, this thing's going to come off through. I'm not saying it's going to crash and all this other stuff, but that 22 multiple is going to come. I think it's going to come right down to 20. Okay, and you could see a quick 500 S&P points come off this thing. Okay, yeah. Just because. Okay, now we know we can't justify. We have risk-free yields greater than market yield earnings yields right now, and that normally is not a very healthy relationship.
And you're talking earning yields, not dividend yields. That can be something that dividend
Correct.
Yield is something that probably gets a little bit more talk than earnings yield. And just to clarify, if a stock is at $100 a share and earns $5 a share and pays a $2 dividend, it's got a 2% dividend yield, but a 5% earnings yield. So if I can get a 10% treasury, or if I can get a 10-year treasury that pays 6%, well, then I can earn more, even including the profits. Forget the cash flow, even the overall profits of the company. I can get more return from a risk-free bond than I can from rolling the dice in the stock market.
Right, because your earnings yield is what's going to grow the stock price.
Right.
So, I mean, and that's the multiple is the multiple. So it has to be the earnings yield that's going to grow above that. I mean, you look at a market that's at 20 times, it's got a 5% earnings yield. If it's at 25 times, it's got a 4% earnings yield. So we're 22.5 times. So we got a 4.5% earnings yield right now. We have a 4.6% 10-year treasury now. The S&P, like we've talked about this before, that the earnings really, really, really need to pull their weight. If they don't, I think it's going to be. I think it gets up real quick, or it builds pop. The bad girlfriend shows up, yeah. Right? So and back to your yields go up, the market goes down now. That's now good news is bad news.
Right.
So we're in a good news, bad news regime now. So good labor numbers, yield goes up, market might not like that. That's the regime we're in right now. So knowing that we're in this sort of environment, and we're stretched for that. Remember that banjo string?
Yeah.
It's really tight right now.
Yeah.
So if anything sets off the yields, anything sets off the wrong way in earnings, it could come back in a quick hurry. I'm not being bearish at all. I'm not anything like that. I think this market is going to do well this year. I'm 6,800 to 7,200. I think it's going to be a good year. I think earnings are strong, all those other things. Typically, we see the highest multiple. The S&P lives in its highest multiple when the 10 years between 3 and 5%, which is where we're at now. Okay, because obviously that's when the economy is growing well, but interest rates aren't too high. It's when the economy cools off, gets below 3%, 2%, something like that, that the multiples come down because there's not enough economic growth to sustain a high multiple or decent yield on the 10-year Treasury note.
One of the things that the financial services industry does an amazing job of is making these simple things sound complicated, and I think we do it so we can charge more money to answer the problems that we created in our confusing language sometimes. But one of the examples of that is, all this earnings yield, dividend yield, bond yield. Putting that in another way, if you just take I think the Treasury yield right now is at 4.77. I think that basically equates to about 21 times earnings. If you wanted to put a price multiple on the bond market, you would say it's priced at 21 times earnings right now, right? We do a really cool job of using multiple terms to confuse things, right? So we talk about earnings yield is inversely correlated to stock prices, but earnings yield is also inversely correlated to bond prices. So then that makes it really hard to understand what are we talking about here. Basically, if bond yields go down from here, or their multiple is going up, which makes them less attractive than stocks, and vice versa. So right now the market's at about 22 times earnings, bonds are at 21 times earnings.
There's 22.45 for 2025. However, the 12-month, which is the 12-month multiple, right, is where we live at, is 22.28.
Okay, and right this very second, 1:45 Eastern Time, January 24th, 2025, the 10-year Treasury is 463, which if you take 100 and divide it by 4.63, you get 21.598, so 21.6. So right now you're paying 21.6 times earnings to buy a 10-year Treasury and 22.28 times earnings to buy the S&P 500. So we're kind of already there.
We're there. As I said, we have an inverse relationship right now.
Yeah, that's what you talked about on the last show, is that doesn't happen very often. So, and I think that's important. Right now I can make slightly more from investing in the bond market risk-free than the S&P, than in the stock market. But the reason we do that is the bond market isn't going to grow that earnings, so to speak,
right,
where the S&P or in the stock market you can. So, as always, the Intelligent Investment Show is for your entertainment, education, and general amusement purposes only. It is not intended to be financial advice or investment advice of any kind. Neither Matt nor I or any of our companies or associated entities know anything about your financial circumstances, so it would be unwise for us to tell you what to do with your money. We encourage you to seek a professional if you do have questions about your portfolio or your financial plans. If you would like to reach Matt and his team, you may do so by giving him a call at 702-655-8300 or visiting intelligentinvestment.com. We thank you for joining us. We'll see you next time.